You've saved or received a meaningful amount of money, maybe 50K, maybe 100K, and you know you should invest it. So you search how to invest 100K, and immediately you find 10 different answers. S&P 500, global index funds, dividend portfolios, property, robo-advisors, all presented as the sensible choice. But once the number gets big enough, the question changes. It's no longer which one works. It becomes, what if I choose the wrong one? Because this number isn't abstract. It represents years of work, a meaningful step forward, or money you genuinely can't afford to get wrong. So the research continues. Another video, another comparison, another forum thread. And the money stays in cash. Not because you don't want to invest it, but because you're trying to find the perfect portfolio when that's not actually something you can look up. In this video, I will show you why this feels so difficult and the structure that makes it manageable. Not the perfect portfolio, but a way to move forward without needing the perfect answer first. If you are sitting on a large sum and feeling uncertain what to do with it, that uncertainty isn't the personal failing. The people I work with in this position are not financially irresponsible. They've built the savings through discipline and deliberate decisions over years. Most are comfortable with the compliance side of money. Tax returns, pension contribution, ISA allowances. They understand the rules, they follow them. But compliance finance is rule-based, investing is judgment-based. And that difference matters more than most content acknowledges. So people tend to land in one or two places. Either investing feels uncertain and the cash feels safer, so they tell themselves they'll move forward when they understand it better. Or they treat it like a precision exercise, find the right stocks, wait for the right moment, get an edge. Both responses make sense given what most content looks like, but neither reflects how long-term investing actually works. If you're new here, I make videos about building calm financial systems that buy you security, choice, and time. A lot of my content has been focusing on the foundations, building a security layer, structuring pension and ISAs, and understanding what financial freedom requires in numbers. If you haven't sorted those yet, I've linked a video below that walked you through the highest level of structure. This video assumes you've already done that, or at least you're on your way. You have emergency cash. Money is going into pension and ISAs. You have a rough sense about what you're building toward. What's left is a sum in cash that should be working harder, but you have no clear way to act. That's what this video is for. Back to those two responses. Avoiding investing entirely or treating it like precision exercise, both come from the same misunderstanding. Most people assume successful investing comes from knowledge or timing. Pick the right stocks, enter the right moment, get an edge. But that's not what the evidence shows. Across long periods, diversified markets have delivered strong returns despite wars, crashes, and recessions. Adjusted for inflation, $1 invested in the US stock market in 1871 grew to over $35,000 by 2026 through nearly 20 major crashes. And it's not just the US. In the UK, long-term data from the Barclays Equity Guild study shows equities delivering around 5% a year above inflation for over a century, ahead of bonds and cash. Over long periods, markets have tended to go up, not in a straight line, but in a clear direction. And the investors who benefited were not the ones who timed it perfectly. They were the ones who stayed invested, not by picking winners, but by owning the market broadly. A janitor in Vermont quietly accumulated $8 million doing exactly that over decades. You likely have more resources than he did. It wasn't sophistication that made the difference. It was having an approach that didn't rely on picking the winners. The edge isn't in expertise or perfect timing. It's in already have the winners in your portfolio and stay invested long enough for them to do the work. If investing is structural rather than predictive, why does the research loop continue? Because every answer you found was built on someone else's input. Most content is built for the US. Different tax systems, different accounts, a complete different map. Even within the same system, the mismatch remains. For example, a lot of the advice suggests you should include bonds and frames 100% equity extremely risky. But if you're looking at the money you won't touch for 2 or 3 decades, like a pension, that may not fit your situation at all. The person who swore by EQQQ can tolerate 40% drop. If a 10% dip unsettles you, that structure won't hold. These answers are not wrong, they're just not answers to your situation. And here's honest truth that's rarely told. There was never a single correct allocation to find. Every portfolio reflects specific inputs. Change the inputs and the structure changes. So more searching doesn't reduce risk, it just delays action. Following someone else's allocation doesn't reduce exposure, it just gives you someone else to point at. However, that's not an argument for doing everything alone. The inputs come from you, but turning them into a structure is where most of the friction sits. That's the work that can take a month alone, or about an hour with someone who's seen it many times before. More on that later. There's a second misunderstanding. Most people picture investing 100K like this. Choose a portfolio, commit, live with the outcome. That makes it feel binary, permanent. But portfolios don't work like that. They can be reviewed and adjusted as your situation changes. Not constantly, but when your timeline or needs genuinely change, the structure can change too. The decision feels heavy because it feels final. It isn't. So here's a reframe. You're not choosing a perfect portfolio. You're deciding what jobs this money needs to do. That shift matters. When you ask which portfolio is correct, you're looking for something external. The search doesn't end. When you ask what this money needs to do, you work from your own inputs. How long before you need it? Do you already have a security layer? Could you leave it alone through a 25% job? These questions have answers, and once they're clear, the structure follows. The tension between growth and safety stops competing. Different parts of the money can do different jobs. And once you see it that way, the decision usually becomes much simpler than you expect. Because at its core, investing is just about owning the market broadly and staying invested over time. At the simplest level, diversification doesn't require complexity. You can buy a single global fund and already own thousands of companies across the world and different sectors. If that works for you, it's enough. In many cases, it's actually the solution. I've tested more complicated portfolios myself, different combination, tilts, strategies. None of them reliably outperform a single global fund. And maybe I'm not especially good at this, but the data points in the same direction. Most professional fund managers don't consistently beat the market after costs. The challenge isn't that the simple doesn't work, it's that it feels just too simple to be the right answer. I understand that. For high achievers, effort usually improves outcomes. Investing is one of the few areas where that doesn't hold. So if one fund already makes sense to you, you can stop there. If it doesn't feel sufficient, not logically, but psychologically, then you can structure properly. This is the framework I use. Every portfolio is a combination of few roles. This is for education, to help you think about the structure, not a specific recommendation. At the center is your core, a global diversified fund holding thousands of companies. This does most of the work. For many people, it's enough. That's how I think about my ISA. No tilts, no extra layers, just something I can rely on to compound steadily. Around it, you can add smaller roles. Calm is for money that has a shorter timeline. If you need a part of it in the next few years, it shouldn't carry the same risk as your long-term capital. That's where bonds, money market funds, or income-focused assets come in. Their job is not to grow aggressively, it's to be there when it's needed. There are more nuanced reasons for introducing assets that behave differently to equities, but those are more advanced considerations, not essential at this stage. My living costs this year, for example, sit in a money market fund in my general investment account. I'm withdrawing from it monthly, so there's no need to use any ISA space for it. And because it's not in equities, it isn't exposed to market timing risk. Next one is growth. Growth is a deliberate tilt for money with a long enough horizon to take more risk. More concentrated exposure, technology, momentum, or similar. My pension looks like this, 100% equities with a growth tilt. I'm not accessing it for decades, so short-term moves don't matter in the same way. And then there's curiosity, the ideas you keep coming back to, crypto, AI, semiconductors, whatever the current theme is. Online is everywhere. There's so many content about top 10 ETFs about to explode. If you miss this, you are behind. And it creates the quiet pressure that if you don't act, you'll regret it later. The problem is, trying to suppress the instinct completely doesn't usually work. It either keeps you stuck, or it shows up later as a much larger position than it should be. So instead, you contain it. A small allocation, 5% at most, separate from the rest. For me, that is crypto. When it grew, I took out my original investment. What remains is only gains. Whatever happens, the core is untouched. That's its role. Not to drive returns, to absorb the urge to act. Most of the outcome comes from the center. The rest helps you stay invested. And this structure isn't fixed. It's designed to change as your timeline changes. As you get closer to needing the money, part of the portfolio can move into the calm layer, not all at once, but gradually, based on what you need in the next few years. Some eventually build that layer to cover the ongoing spending, for example, a dividend portfolio. Others draw from it while the rest continue to grow. The point is, you're not trying to get it perfect today, you're setting up something that can evolve with you. Once you see that, the decision changes. You're not trying to find the perfect portfolio, you're structuring it. One global fund is already a complete portfolio. Everything else is optional. Once the structure is clear, the remaining questions become separate questions rather than one overwhelming choice. What goes in the growth layer? Where geographically? Passive or active? Do you build it yourself or use something pre-built? They are all worth answering, but they are different questions, and trying to resolve them all at once is exactly what sends people back into the research loop. I'm planning to go through each of the dimensions in the coming videos. My instincts should start with the geography question, global index versus US focused, because that's the one that comes up most. If there's a dimension you'd like to hear more on, tell me in the comments. I will prioritize the topics based on your feedback. If you've been sitting on a large sum and haven't acted, take this. You're not behind, you're not bad with money. It feels hard because most content either tells you what to buy or overwhelms you. What you need is a structure grounded in your situation, your timeline, your existing security, your tolerance for movement. Once those are clear, the decision becomes simpler. Not perfect, but clear enough to act. Successful investing doesn't come from optimization, it comes from a structure you can stick to. That's within reach, it always was. If this framework makes sense, but you're not sure how it applies to you, your timeline, your accounts, the money you're deciding on, that's what the allocation diagnostic is for. It's a focused 60-minute session where we turn what you already understand into a structure you can act on. Not generic, yours. Most people come in knowing the pieces. They leave knowing how they fit together. If that would help you, the link is in the description. And if you want to go deeper, I've linked 2 videos below. The first covers the thinking that sits before this video, how to approach security, flexibility, and what your money is building toward. If you haven't worked through that yet, it's worth watching before you build a portfolio. The second one looks at why high earners can still feel financially insecure even on strong incomes. It also explains why the instinct to protect the money feels so strong when you're making this decision. Thanks for watching. I'll see you in my next video.